Hello students, this is Dr. Chetna Kumawat and we are understanding ratio analysis. In a previous lecture, we have studied meaning of ratio analysis, expression of ratios, objectives or significance of ratio analysis. Now let's understand limitations of ratio analysis. Ratio analysis, as already mentioned, is a useful tool of financial evaluation of business firms. But it should be kept in view that ratios are only guide in analyzing the financial statements and not conclusive end in themselves. If these ratios are misused, the results will be incorrect and misleading. Therefore, the analyst should be aware of the weaknesses and limitations of ratio analysis while analyzing financial statements on the basis of these ratios. The important limitations are identified are as follows. Number 1. Need for comparative analysis. A single ratio would not be able to convey anything, as the single ratio in itself is meaningless. It does not furnish a complete picture. Neither it can be explained nor any decision can be taken on this basis. Hence, it is essential to ponder over all relating ratios while drawing inferences. For example, current ratio alone is not a proper measure of liquidity unless it is supported by all liquidity ratios, that is, asset test ratio, inventory turnover ratios, etc. Number 2. Qualitative factors ignored. Ratios are arithmetical expressions, so that qualitative aspect cannot be presented through ratios. Normally, qualitative factors that may influence the conclusions drawn are ignored while computing ratios. For instance, a high current ratio may not necessarily mean sound liquid position when current assets include large inventories consisting obsolete items or major part of debtors is bad. Therefore, in making decisions with the help of ratios, utmost care should be taken. Number 3. Possibility of window dressing. Window dressing means manipulation of accounts in a way so as to present a better picture than what it actually is. By doing so, it is possible to cover up bad financial position. For instance, better liquid position by postponing purchase of desired fixed assets for some time, acceptance of deposits by banks from their customers for a week at the end of the year to show better deposit position, etc. Therefore, ratios based on such figures are not reliable. Number 4. Inherent limitations of accounting. Ratios are calculated from accounting records which are subject to accounting principles, conventions, concepts, and personal judgments. Any ratio based on the facts and figures of such financial statements suffers from inherent limitations. For example, ratio based on under-recorded purchase by directors will provide misleading information about the profit and financial soundness of the business. Number 5. Difference in accounting methods and systems. Comparability of financial statements is affected when various differences are traced out in accounting methods and systems followed by different firms. Lack of standard formula for calculating ratios make it more difficult to compare, as ratios are worked out in the basis of different items in different industries. Number 6. No substitute for sound judgment. Ratio analysis is one of the methods of interpretation and drawing inferences. It only provides few information for decision making. Conclusions drawn from ratio analysis are not sure indicator of bad or good management. They merely convey certain observations which need further investigations. Otherwise, wrong conclusions may be drawn. That is why it has been aptly said, ratio analysis is not a substitute for sound judgment. Rather, it is a helpful tool to aid in applying judgment, otherwise complex situations. Therefore, computation of ratios is not useful unless they are interpreted. Number 7. Lack of standard ratios. In practice, there is no uniformity in the definition of various terms used in ratio analysis. For example, some companies treat net current assets, that is, current assets, current liabilities, as working capital, while others only current assets. As such, the ratios of one firm cannot be compared with the ratios of other firm or whole industry. Comparison requires ideal ratios, but in a dynamic financial and economic scenario, it is very difficult to evolve a standard ratio acceptable to all for all items. Personal bias. Ratios have to be interpreted, but different people may interpret the same ratio in different ways. Ratios are only means of financial analysis, but not an end in themselves. It should be clearly noted that ratios are only tools and the personal judgment of the analyst is more important. If the analyst does not possess requisite qualifications or is biased in interpreting the ratios, the conclusions drawn will prove misleading. Effect of price level changes. Changes in price level affect the comparability of ratios. A change in price level can seriously affect the validity of comparison of ratios for different years. For instance, a firm which has purchased an asset during deflation at low prices will show a higher return than the firm which has purchased the asset during inflation at a higher prices. Now, let's understand what precautions can be used while using ratios. Ratio analysis is a widely used technique in analyzing the financial activities of a firm. If ratios are used in a wrong way or carelessly, there is a possibility of conclusions being misleading. Therefore, while using ratios, following precautions should be taken into consideration. Number 1. Ability to understand accounting data. The user must be capable to understand the nature of accounting data used in preparing financial statements, from which ratios are calculated. It is much more essential when efficiency of one firm is compared with that of another firm. In such a case, the figures must have conceptual uniformity and be comparable. Number 2. Speedy compilation. Speedy compilation of ratios is desirable because the utility of these ratios depends upon the timely availability to the person concerned. How speedy these should be made available depends upon the nature and urgency of ratios. Number 3. Cost benefit. There is a cost of calculating ratios. Therefore, undesired or useless ratios should not be computed and an equilibrium between cost and benefit be maintained. Presentation. The utility of ratios to a great extent depends upon their presentation. Only those ratios should be presented before the concerned person which are to be considered. For example, ratios of productivity should be presented before the production manager. The last one, incorporation of changes. Ratios should be revised as per changing business conditions and assumptions. In the beginning, a few ratios are computed, but as business grows or expands, new ratios should be incorporated.